Hey guys, welcome to our Disney Market mini series here at the Short Term Show. Make sure you like and subscribe. We're doing a 10-episode deep dive on not only this market, but all of our markets. So definitely check those out. Like and subscribe to those, the Short Term Show, Short Term Rental Management Show. We got a lot of shows out there for you guys that hopefully you guys are finding helpful. So a couple things that I want to hit before we go into it is if you are looking for current purchase prices or current income numbers, we have those on our website at theshorttermshop.com. So be sure to check that out. Also, if you're looking to just hang out, learn some things from some other short-term rental investors, we've got you. You can join our Facebook group with us and 60,000 of our closest investor friends, where we just hang out and talk about short-term rental investing all day. Same title as my book, Short-Term Rental, Long-Term Wealth. Also, like and subscribe on YouTube to the Short Term Shop channel. Also, like us on Instagram at the Short Term Shop. If you guys have any questions, if you're ready to maybe buy a property in one of our 20 markets and learn how to manage it from us for free, you can hit us at agents@theshorttermshop.com or literally any of the other avenues that I gave you right before that. So let's get to it.
Here we go. All right. Episode 6, Orlando of the Short Term Show. And we are talking about financing today. And we do have a licensed MLO on the call, Mr. Johnny. And we will talk about all different types of lending. And of course, from the noob's perspective. And of course, really the most popular loan product out there is going to be, kind of your conventional loan, Fannie Freddie. So Johnny, can you walk me through what is Fannie Freddie? What is a conventional loan, and what type of buyer would be looking to use that?
Yeah, so Fannie Freddies are they're investors, right? They buy loans from banks, from brokers, from all over the place, right? Mostly lenders, and they come in and they insure the loans, right? So as long as you follow their guidelines and their requirements, then you'll be able to go ahead and qualify for it's basically your conventional loans, right? All your conventional loans. And so of course they have income qualification to credit qualification, all of those different things. And you can come in with a couple of different types of products that people like to use for a vacation home. Of course, there's a 10% down product. People like to use that product to be able to get, into their first short-term rental. And then there's 15% down investment products. Of course, Fannie Mae and Freddie Mac, they guarantee up to a loan amount of currently as of today, right? They're moving towards the $750,000 max loan amount. Anything beyond that would be considered jumbo and not under the Fannie Freddie guidelines. So that's kind of how that works. Debt to income ratio, you can kind of expect, a 50% debt to income ratio. Of course, your down payments, the 10 and 15%. I think that kind of covers your conventional type products.
Is a second home loan at 10%? Is that conventional?
Yes.
Okay. And what is a second home loan, and can I use it for rental?
Yeah, so for each lender is going to be a little bit different on the second home vacation type product. For us at the mortgage shop, we allow you to use it as a rental, but when you're qualifying, you actually have to qualify in your own income, right? So you won't be able to use any of the rental income to qualify for the second home. However, as long as you're staying there a minimum of 14 plus days out of the year, and on your tax filings, you're filing it as a owner occupied plus rental, then you should be fine to use a second home product with us here at the mortgage shop. And I think it's a pretty easy way to enter into the business. So you can rent it out the rest of the time when you're not utilizing it as your vacation home.
How far away does your vacation home have to be from your?
So usually we like to give it a 50-mile radius is kind of what we would anticipate, and it has to be further away from your current home. Anything that's too close to your home would be considered investment property because you live really close by. However, if it happens to be that you live in let's say, for example, a beach market, and you want to buy in the Disney area, then even if it's 25 miles out, we might be able to go ahead and do that as a second home because it's a totally different environment.
Okay.
And so, yeah, there's exceptions to the rules, right? But we like to say 50-mile radius is probably going to be your best case scenario.
On DSCR, that's all the rage these days. What the hell's a DSCR loan, and who would want to use such a thing?
DSCR loans are loans where we don't income qualify you. We use the income from the specific property to qualify itself. Now, you still have to have the down payment. Usually the down payments are higher. We're seeing somewhere around 20 to 25% down payment required. Rates are going to be a little bit higher. There's going to be prepayment penalties. Folks that will use it are typically folks that either can't prove their income and are making pretty good income. Like, for example, real estate investors, typically you have all of your money involved inside of each transaction that you have going on, all of your portfolio. So your cash flow might not look positive on your tax returns. However, there's a likelihood that you are actually cash flowing really, really well, but we can't prove it from a document standpoint. You would be using the DSCR. Or if you started a new job, like, and you went commission based or self-employment based, when you're doing that, then of course you're going to want to come in and do a DSCR. The DSCRs allows you, like I said, 20-25% down. As long as you have decent FICO scores, you can come in. Sometimes people come in and they use the DSCRs to be able to have their properties closed in an LLC. All of those folks would be the type of people that would be using DSCRs. And so then for DSCRs, what we typically require is that the property makes a monthly income that will cover for their principal, interest, taxes, and insurance payment. And so as long as they're covering for the PITI as well as the HOA dues, right, then they'll likely qualify if that property can make that type of income. Now, how we determine that income is a couple of different ways. We have the 1007, right? So the 1007 is a form that the appraisers will complete, and they'll review the area for the similar types of properties and what they're making from a rental perspective. And then they'll do an analysis and they'll send that in. So wherever that income comes in at, based on what the appraisers say, that's what we utilize. Now, there are other DSCRs that do not utilize that process. And what they'll do is they'll do a analysis through AirDNA as well as their own analysis on Airbnb, VRBO, and do a manual calculation to determine where the income is going to lie. And usually in the Orlando market, that's probably the route that we prefer to go, is to go ahead and do the DSCRs where they allow us to use AirDNA.
Is it, would I rather use a conventional loan if I can, or maybe not?
Yeah, I think you would, just because of the prepayment penalties, right? I mean, it's going to depend on your specific scenario. If you got good money down, like if you got, let's say, 25% down, and you have your income qualifies from a conventional perspective, and you're buying in underneath that loan amount of $750, then I would go ahead and say that you would probably want to do it as a conventional, because there's no prepayment penalty. The rates are going to be lower. The points are going to be lower, and you're probably going to be better off moving that direction.
Is there another option besides DSCR for over 750?
Yeah. So we have jumbo loans, right? So jumbo loans are similar to that of conventional. A lot of the lenders out there that do jumbo loans normally underwrite it based on Fannie Mae's guidelines. And so anything above that, you are able to do a second home 10% down if the rates allow it, right? Currently, rates aren't really allowing for it, which means the interest rate charge is too expensive for us to be able to charge as a lender. We have federal requirements that only allow us to charge up to approximately like 3%. So if points are going to be costing over 6%, then you have to have a seller pay for the closing costs for the difference in points for you to be able to qualify. And so it's still possible. It's just it's a little bit more difficult and challenging to do. If you had 20% down and you want to come in and do a jumbo, typically rates are going to be just fine. So you can definitely do loan amounts above that with a similar style of underwrite as conventional. Of course, the debt to income ratio is going to be different. The debt to income ratio is 45% on the jumbo loans. And so as long as you qualify, I think that's typically a pretty good route too.
Okay, wonderful. Let's talk commercial loans. I know, Johnny, that's not what you do. I've used several of them, so I'll kind of give that speech a little bit. A commercial loan is generally when we go to a local bank. It's also sometimes you hear it referred to as a portfolio loan. And again, I'm no expert on the subject, but that's where I do most of my lending these days. Because again, eventually you're going to run out of conventional loans. You get 10 per person, 20. If you're married, you get 10 each. You keep going down this road, and you might run out of them, and that's a good problem to have. And I know that sounds crazy when you're first starting, but believe me, man, I look back and I'm like, damn, those things were gone quick, So then eventually you get into commercial loans, or maybe you go straight into them right out of the gate. It depends on your appetite and I guess your financial standing and that type of thing. But usually what that means is you're going to call a local bank. I usually like a bank that has, maybe 8 to 15 branches. Somewhere in that size of a bank is ideal for me personally. Once they get bigger than that, they usually don't even want to deal with, single family homes. And then basically, really, for lack of a better way to put it, what they're doing is lending you the money out of their clients, their savings accounts. And your job is to go out there and make more money with it, make more money for the bank and for the people whose money that you're borrowing. Now, nobody really thinks of it that way. I don't think somebody going in there to drop $100,000 into a savings account is thinking about this crazy guy with long hair and tattoos going out and using that money in rental real estate. But that's kind of how it works. And they're going to qualify you based on it's where DSCR, that term comes from, is where the commercial loans, that's what they do. They do it based on debt service. In other words, how much is it going to make versus how much is it going to cost? It's really as simple as that, the terms are not nearly as good on commercial loans. It's usually going to be a 20-year AM, a 5-year fixed or variable rate on a 20-year AM, which means it's basically you're paying it as if it's a 20-year note, but you only get it for 5 years. And at the end of 5 years, you usually got to basically just renegotiate, for lack of a better way to put it. But it's a great option. It really is. I got a few buddies that have always done those, never even bothered with conventional. I don't know why you wouldn't start with conventional at least, or save those conventionals for like really big purchases, and maybe you want to do commercial for some smaller stuff in the early days, that kind of thing. But one more thing on that, people at the commercial lender, the person you're talking to has no idea how conventional loans work. And the conventional loan people generally have no idea how commercial loans work. They're completely different worlds, different animals. They both have their place. I guess for lack of a better way, just to kind of throw this out there, commercial loans are maybe more for people that are a little more experienced. I hate to say that, because you could definitely start with commercial loans. But it's generally the folks that have been doing rental real estate for a really long time or have a ton of properties. That's kind of generally where you're going to see people using commercial loans.
I got a couple of things if you don't
go
mind.
ahead, Johnny.
Yeah, so we do have a couple of like commercial products. They're very different. They're day and night from the conventionals. How they get underwritten is totally different. When they come in, it's not like for conventional and for your normal residential type loans, you kind of have an idea of what you're going into. But for the commercial stuff, you don't know until the committee has looked at it, right? So you have to send the deal in. We'll take a look at everything to see if it's going to be okay. Typically, you need like 30% down for our products. And then each one's a little bit different. It's like Luke was saying, was that the terms are different. They're typically balloons, right? We have I think a 3-year, a 5-year, and a 10-year balloon. Interest rates are whatever it is that the committee decides. And so you're not going to know right off the bat where like you on a residential, you can quote rates right away. On commercial, sometimes you can't. We can give you a general idea of where they're going to be at. Like I just checked the other day with one of my clients, and it was like around 8%. And the thought is that if you can get into it, it's great. What's cool about commercials is that you can blanket properties, right? So if you got multiple different properties, they allow you to, do it on do one loan on multiple different properties, so you're not paying closing costs on a bunch of different ones. But there is, I think, it's a cool product, but it's very different from that of the regular residential loans.
Well, when we have a client or we recommend you to a client and they call you, do you go over all of these options with them? Or if they're like, hey, I just want a 10% down loan, or do you like, what is the process if I'm a new buyer calling you? Will you go over all of this in detail with me?
Like, we typically don't go over every single thing. It's gonna depend on what you're looking for, right? If you come in and you're saying, I just want to buy a single family home, and like, this is gonna be my first one, we're gonna try to do conventional first, right? Right off the bat, just because it's going to be easier. It's not as complicated. There's no balloon on it. There's no prepayment penalty. It's an easy process. Most people are used to it because they already currently own a home. And so the process is a little bit easier for them. Now, if you come in like, there's some clients that they come in and they already have like 20 different properties, right? And they're asking, okay, so what can I do to get financing? We'll have to take a look at all the different options and say, okay, so here's the best options, and we'll give them the best 3 options, and then they can take a look at which direction they want to go.
Also want to add the commercial loans that I was talking about. A lot of times, probably might not work for short term. It depends on the bank. A lot of times they're not going to really even understand what you're talking to them about, because they are typically pretty old fashioned, these local banks, and they might be Airbnb. What is that? They are very conservative for the most part. So keep that in mind if that was something you would be looking to do. So a lot of buzzwords out there, a lot of cool new hip stuff going on that, quite frankly, makes me feel kind of old, and I'm going to lean on Wade for this one because I know he's a little bit younger. And I think a lot of these things that we're about to talk about might not apply too much to vacation towns, because we are talking in general some more expensive type properties, and I think generally the sellers are probably not going to be interested in doing some of this stuff for the most part. And also, a buyer to go out and buy a $900,000 house, you got to be a pretty qualified buyer. But let's talk about. Let's start with sub 2, which is super hot. I personally, I don't really know all that much about it. Wade, I know you're in a couple of deals right now. Can you kind of give us a rundown on how that works?
Yeah. So sub 2, if no one's familiar with this, is essentially a taking over payments option. You take over the payments of the original owner of the home. Now, there's a little bit more to it than that. You're not just like, oh, I'll take over your payments and the home is mine now. No, it's not exactly how it works. There's a little bit more to it. But you are taking over the payments of that person. And usually you'll also give them some sort of capital as well. So you take over the benefits and then you'll pay them some sort of difference in the purchase. So if the home's worth $200K and there's a loan on it for $100,000, so there's $100K, you take over the $100K that's financed, and then you are then giving, air quotes, giving another $100K to the original owner of the property for a total of $200,000. Now there's other ways to finance that total. You can seller finance part of it, maybe do a balloon, something like that. There's other ways to do it, but that's generally the scope of what sub 2 is.
I'm old fashioned. My way is just work hard, save up some cash, and go get a damn loan. So this, and I'm not saying this won't work, but go ahead, Wade. What you had another point there?
Well, I was going to lead into, it is a really difficult deal to find. We see a lot of people pushing it right now. They're phenomenal deals, especially if you can get great terms on them. They're excellent. But in traditional Airbnb markets, especially ones that have appreciated to the point to where the homes are physically more expensive, where if you were to go 5 miles away to a residential district, the residential homes are much cheaper because they're not standard short-term rentals. And so when you're in a short-term rental market, a lot of the owners there are professional investors. Some of them are hedge funds. Some of them are international owners, things like that. They're not interested in these creative finance deals because they're trying to get their money and they're trying to go buy another property. So yes. I will say in a lot of markets, we happen to have a couple that have come up here and we happen to be very familiar with these types of deals. but they're very, very hard to source and locate in traditional Airbnb markets. So just be prepared for that. If you're trying to do a creative deal, definitely try, but also be on your toes, because you're probably going to get shot down a little bit, right? I've probably made over I would say over 250 offers now of some sort of creative finance thing, just something creative, and we've successfully closed 3. That's not me, that's all my buyers put together, including myself. And so 3 out of 250 is, and 2 of them I was on the selling side. So it's a hard deal to come by in a Airbnb market.
Yep. Okay. And we pretty much covered this as well, but a little deeper on seller financing. That's a term that we didn't hear at all for a number of years, but it is starting to come back around. One thing I want to note about seller finance is that the seller would need to own the property outright. They are the bank, basically. If there's a middleman on a seller finance, that's not going to work. So, we see a lot of people that say, well, can you just ask the seller if he'll seller finance it to me? Which, again, to me, that sounds like it's a buyer that can't get a loan. I hate to say that, but I've been in those shoes, man. I've been in those shoes where I couldn't get a loan. And guess what I did? I worked my rear end off and I went and figured out how to get a damn loan, but I get it. Don't take no for an answer. Be shot out of a cannon. I get that. But just be advised that seller finance, there's a reason they're doing that. They want to get juiced. They want something out of you, and it can work. It's really rare in a property that we're talking about in this, $500,000 plus range. You guys ever been involved in a seller finance deal in all of your transactions?
No, lots of attempts as well, but no.
Never succeeded.
No.
Yeah. They're hard.
Yeah.
Yeah. And people, I think, confuse the term subject to and seller financing
all the time
together a lot, and so that makes it a little bit difficult. So it's, again, just knowledge and figuring things out and having a good team. There usually needs to be attorneys and other people involved as well.
Also, it is a very, I don't want to say American ideal, but it's something that's very here in the States. Internationally, we have a huge amount of international owners as well. They think I sell my home, I get my money, which is very common. A lot of them don't have the just like the education in terms of seller financing or sub two. So being able to find a seller who's open to those new types of financing can also be difficult. So
right. A lot of our market sellers are foreign. So imagine living in another country and hoping to get money monthly from somebody.
It can be difficult. It's really difficult. And hedge funds, large owners here who might have like 15 properties, they usually want to sell and go invest elsewhere. So it's difficult. Now, shoot your shot. It's definitely an excellent way to get a deal, but be prepared for that difficult uphill struggle.
Yeah. Yeah, it's a tough one. Financing, Johnny, can you cover refinance? Who'd be a candidate for that? HELOCs, HELoans, et cetera. What do those terms mean?
So refinancing is typically pretty good when you can go out there and you can get financing from your primary residence, which the lower the interest rates are going to be lower on primary financing. You can go out there and you can get additional funds. Let's say you have a ton of equity in your current home, your primary home. And you can take out, let's say, 25% of whatever the equity is. Let's say $100,000, right? You're able to take out $100,000. You're going to be able to use it towards the other property or purchasing a new property. It works out pretty well if you can do a refinance. In addition to that, if you bought a home and you fixed it up and you got it to where you created a value add to the property, and the values are higher now, you can come back and do a refinance, or you can go and do a BRRRR method and pick up another property, right? When it comes to HELOCs and HELoans, right now the interest rates are pretty high. Back then, when the interest rate was much lower, you can jump in, get a line of credit, right? A home equity line of credit, and be able to utilize it kind of like a credit card. As you pay it off, you can reuse the line of credit to purchase other different properties. And the only thing is that you got to make sure that you qualify. Talk to your loan officer, make sure you qualify with both the new payment and the home equity payment, right? Now, home equity loans is just a second loan, right? It's like the home equity line of credit. They're both second loans, second mortgages that are put onto your property. However, home equity loans functions just like a normal loan, right? Once you obtain it, they give you a lump sum at the beginning, and you make monthly payments on it throughout the rest of the transaction, right? Whether that be 30 years or less, whatever it is that you are able to get that for. People used to use it because, it was easy to get. It didn't cost as much as a true refinance. You can jump in, get the banks to pay for the appraisals, but however, right now it's a little bit more difficult, right? It's a little bit more difficult. I'm seeing rates above the 8.5%. Sometimes you can find a deal where you can find a credit union that might be able to give you a standard rate for 1 or 2 years or something like that. And if they can do that, then of course the rate's going to be a little bit cheaper than the standard rate, but eventually it's going to go up. Now, my thoughts is that we are inching towards the top of the interest rates, and so we're hoping to see interest rates come down next year. And if the cool thing about home equity loans and home equity lines of credit is that as the interest rates drop, typically so does your monthly payment, right? So as long as it's still a variable rate out there, it'll drop. So I think that kind of covers what it is. It is all equity within your home, right? That's same with refinances. If you want to do a cash out refinance, you want that equity in your home to be able to pull it out, utilize it, make some more money on it, right? So you're able to do that through doing refinances, home equity loans, and home equity lines of credit. I do want to touch on rate term refinances. Rate term refinances are refinances that you would just do a refinance on your current home, hopefully drop the interest rate. We're probably going to see more of that coming here in the next year and a half and 2 years.
Also want to add, if you're going to do a HELOC on your primary and use that for a down payment, please don't run your numbers as the home have the investment property paying that back. That's too much. Honestly, we're not really in an environment where I feel comfortable doing that anyway right now, but it does happen occasionally. So if you're going to do that, I would personally, I don't know that I would do it, but if it was going to happen, I would make sure that you're paying that back, at least on paper, from your day job money. Now, the money that's coming in from the property, I would be throwing all that fuel on the fire and get that HELOC paid off as quickly as possible. That thing needs to go away. But every now and then I get somebody that calls, Luke, I got this house and I'm not making any money. And I'm like, well, let's run your numbers. What's your PITI? And they throw me this crazy huge PITI. I'm like, there's no way that's your PITI. And they're, well, I got a HELOC in there too. No. It doesn't work like that. You got, if you're going to do it that way, which I don't recommend, but if you're going to, I would, again, talk to your financial advisor, your attorney. I can't give you any kind of advice, but make sure that you can pay that HELOC back with your day job or other investments or whatever else. And again, like I said, I'm throwing everything I've got at that thing. Get rid of it. And that's all why you HELOC, because you can reuse it. But again, if you're using it for down payments, could take you a while to pay that back. Be conservative. All right. Anything else to add? Anybody have anything to add on lending in general?
There's a couple products out there that we didn't talk about, and those are like bank statement loans and profit and loss loans. Those loans are portfolio type loans, right? That different lending institutions provide. If you don't have the ability, like to show your income, because you haven't had it, for example, it's just not on your tax returns, right? And you're self-employed, you can go do a bank statement loan. As long as you have a 2-year history of the bank statements, they'll analyze, the bank statements and the expenses that comes out of the bank statement and do an income calculation based off of the bank statement loans, right? So those are pretty good for self-employed people. And then same with the profit and loss type loans. If you have just started your self-employment business and you've got a year in, but you don't have that 2-year history that conventional financing requires, then you can come in and you can do a P&L loan as long as your CPA can produce a profit and loss for 12 months. We're able to go ahead and take a look at that and do that as well. Now, those two products typically require 20% down, so get ready for the heftier down payment, but they are out there, right? So touch base with your loan officers. Maybe they know a little bit more about the specific products.
Love it. All right, thank you guys so much. We shall return for yet another episode of the Short Term Show, special episodes in Orlando momentarily. We thank you so much, and don't overthink it.